Cash flow to firm, or CFF, and cash flow to equity, also known as CFE, are two important financial metrics used to evaluate a company's performance and financial health. While they may seem similar, they have distinct differences. Let's start with cash flow to firm, or CFF. CFF represents the total cash generated by the company's operations, available to all capital providers, both debt and equity holders. It's calculated as net operating profit after taxes, or NOPAT, plus non-cash expenses like depreciation and amortization, minus changes in working capital and capital expenditures. In formula terms, CFF equals NOPAT plus depreciation and amortization, minus changes in working capital minus capital expenditures. Now, let's move to cash flow to equity, or CFE. CFE represents the cash flow available to the company's equity shareholders after accounting for all expenses, taxes, and debt payments. It's calculated as net income plus non-cash expenses, minus changes in working capital and capital expenditures, and after servicing debt. In formula terms, CFE equals net income plus depreciation and amortization, minus changes in working capital, minus capital expenditures, minus debt payments. Let's consider an example with a company named XYZ Corp. Imagine they have a net operating profit after taxes, or NOPAT, of $500,000. Their depreciation and amortization expenses total $100,000. This year, they've spent $150,000 on capital expenditures, and changes in their working capital resulted in an increase of $50,000. Their debt payments for the year amount to $100,000. Now, calculating their cash flow from financing, or CFF, we add the NOPAT to the depreciation and amortization, then subtract the increase in working capital and the capital expenditures, which gives us $400,000. For the cash flow to equity, or CFE, we take the CFF and subtract the debt payments, resulting in $300,000. Now let's discuss the key differences between cash flow from financing, or CFF, and cash flow to equity, or CFE. CFF is used to measure the company's overall ability to generate cash for all capital providers, including both debt and equity holders. On the other hand, CFE focuses solely on the cash available to equity shareholders after meeting all obligations, including debt payments. Understanding these metrics is crucial as they help investors and analysts assess a company's financial health and make informed investment decisions.